Good evening, everyone. Uh, I hope you all are doing good. I'm Chartered Accountant Manubhav Verma. Uh, will be your chauffeur for some important topics in financial management. So before we start, let me give you a little bit of a brief background about myself. I qualified almost a couple of decades ago, also a CPA from United States. Have a training experience of almost more than 15 years. I've also got industry experience of working in companies like, Whirlpool, KPMG, EXL Services for more than a decade, and have been training at various institutes for international financial courses at some colleges, and also, of course, with ICI. So here, I will be kind of taking care of some important sessions with all of you, and I'm sure you are all equally excited. So am I. Uh, and the topics will be, of course, cost of capital to start with. Then after a couple of weeks, we will be having some hands-on on investment decisions, and towards the end, we will be wrapping it up with working capital management. So that is the three areas which you guys will be kind of touching base with me. So I'm pretty sure that everyone is excited to look at and do some practice. And I'm sure that you guys are all geared up as you guys focus on a strategy in terms of preparation. Always remember in life, there are three, no, in fact, no shortcut. There are three ways to succeed, right? One is practice, second is practice, and third is practice, right? In fact, there is no shortcut. And I'm sure with a little bit of a discipline, dedication, and planned efforts, you guys will definitely achieve your goals. And just ensure that whenever you feel tired, or you feel that okay, it's a long journey, always remember one fact, that at the end of the tunnel there is always light waiting for you. So before we start, can I just have a quick check? I hope everyone is kind of pretty much geared up for the session, and Josh is pretty high. So I would like to start this session with a simple question from all of you. What do you understand by cost of capital? And I want to see how many of you want to respond. I want absolutely two-way traffic going on here, guys. I want all of you to be super active. Whatever questions we ask, I want all of you should be responding. And let's see what are your replies. What is cost of capital, guys, as per your understanding? So let's see whose answer I see first. So the first answer coming in from Malay Shubham. They're saying interest on borrowed capital, cost incurred to raise the capital. Ankit says cost of capital means cost of procurement of the source of finance. And Karthik also saying cost behind procurement of funds. But Rajiv Kumar Singh, amazing answer. I'm getting the answer here. Return expected by the investor here, guys. Now this is very interesting. I think most of you are absolutely correct when you're saying that okay, this is a cost to raise the capital, but cost to whom? Cost to whom, right? Cost to the capital providers. And what are we paying them? Their expectations. Cost behind procurement. We are talking about net expenses that would be incurred to acquire some sources. Okay. Sonali Jay Himanshu says cost of capital, meaning the cost organization is bearing, like interest on debentures, absolutely perfect. And Manisha also saying return in addition to principal we have to give when we borrow money. Ritika, I think this is absolutely superb. This is exactly what I wanted. I'm not able to read each and every answer, but I can see everyone is in super form. Sonali says cost of companies fund that they incur to finance operations. Again, guys, absolutely perfect. So I think you guys are absolutely spot on when you say that cost of capital, whatever capital you want to procure, what is cost you need to pay. And when we say what the cost we need to pay, it is considered in terms of the return expected by the providers of the capital. That's what the key point. Now, the capital providers are, of course, it could be the shareholders, it could be the financiers or lenders, And since they are providing money for you to facilitate to set up business, of course, they will expect something in return. And that something is cost of capital. This is also known by some other names like cutoff rate, hurdle rate, or even minimum rate of return. Sometimes we also call it as opportunity cost, because generally we will be using the cost of capital in some other evaluations also. For example, when we will be talking about investment decisions, we will be talking about cost of capital for discounting our cash flows. So cost of capital is generally used in various aspects, in various applications in real life, in practical life, and hence the understanding of it becomes more and more important, right? So now one more thing I would like to talk about, guys. We are talking about cost, right? This is a return expected by the investor. For the organization, it is a cost. And when it comes to cost, everyone wants to minimize the cost, right? Everyone wants to minimize the cost and maximize the revenue. How do we minimize the cost of capital? The way is, we probably will learn how to calculate the cost of each and individual component. Thereafter, we will learn how to calculate weighted average cost of capital, and we would probably select that combination of capital structure, wherein it means, of course, debt and equity, that could result in least cost and maximization of wealth. You know, the goal of the financial management is no longer only profit maximization, but also wealth maximization. So the idea is, you would go for that kind of a combination. You would strive to minimize the cost. Of course, in this unit, we will focus our understanding on learning how to compute cost of capital of individual components, and also the weighted average cost of capital of the entire capital taken at large. And yes, as I said, its utility, it's very, very important. We will be using these fundamentals when we evaluate the investment options, that is capital budgeting decisions. Of course, as I said, financing decision, debt or equity or which combination. And not only that, towards end, when we will be talking about working capital management, there also we will be looking at some opportunity cost when we are evaluating some policies. So I'm sure you will realize as we progress that this is the chapter which will hold its importance throughout your curriculum, and I'm sure even after you guys are qualified. Now, of course, we understand, the cost, the source of the capital comes in from different sources. You can see here, we are looking at equity shares, we are looking at preference shares, your debentures or bonds or loans. So basically, we are looking at two broad categories, equity or debt. And within the equity, we are looking at equity, preference shares. We are also talking about retained earnings separately. Mind you, a retained earnings would also have a cost. Can anyone tell me why? Why would a retained earnings have a cost? Let's see your responses on this. And I'm sure you're having super duper replies already. Why would a retained earnings have a cost? So let's see what are the replies for the second question of the evening. Okay, Shubham says inflation and opportunity cost. Okay, what about others? Okay, inflation could have an indirect impact, yes, but yeah, we'll talk about more direct impacts. Himanshu, awesome. Himanshu says it may have an opportunity cost. Wow. The investment interest that could be earned had it been invested somewhere else. Himanshu, can I also say that probably the amount would have been rather distributed as a dividend, and hence any opportunity cost expected by the shareholders would also be the cost of capital for retained earnings, because that's the amount which is not given to the shareholders as a dividend. Yes, absolutely, Karthik. I think you and me said the same thing. Jay says as we are losing interest. Okay, great. Darshan says retained earnings has opportunity cost because it could be invested somewhere else. Yes, absolutely. So we are all on the same page. That's amazing, guys. Ankit also says that, the return the shareholders should expect on their investment. Ankit, absolutely. And I believe what you are also trying to say is that since they're not getting that back in dividends, they're probably investing and within the business. So of course, they would expect that opportunity cost. Absolutely perfect. So we are also getting some replies from Rajiv. Retained earnings have cost because we have plotted it from our profit, and when the profit have been used at that time, that have opportunity costs. Again, the same thing. Ustad also saying if instead the retained earnings, the profit could be reinvested. Absolutely great, guys. Amazing. So all the answers sinking in. That means we are all on the same page. That kind of creates a balance here. So, and towards the end, once we understand the individual components of calculating the cost of capital, we will be focusing on the combination of cost and weight of each source of capital. So we'll apply the weights to the different proportion of the components, and then we will calculate the weighted average cost of capital. Great. Now, when we are looking at individual components, let us start our understanding with long-term debt here, guys. Now, before even I go to cost of debt, I would like to talk about some important terminology which may be associated not only with with respect to only issuance of bonds or debentures, but may also have some components or some terminology coming in the financial covenants or financial agreements with the institutions. For example, we are talking about first is agreement itself, also known as indenture. Now, which would have terms and conditions. What kind of terms and conditions? Maturity value, maturity period, interest rate, any compliance related covenant. Now, face value, of course, would be, for example, we are talking about rupee 100 bond, right? And then we are talking about coupon rate. Now, coupon rate is nothing but, guys, a stated rate. Like we say that these are 6% bonds. That means these bonds or debentures will be entitled to 6% interest payment. That is my coupon rate. Now, this definitely is talking about of cash payment, right? So whatever the percentage which is quoted to be paid on. Mind you, when we talk about the coupon rate, just for your understanding, in case our coupon rate, we also call it as a stated rate. In case this doesn't equal to market rate of interest, let's see the responses. Who gives the first one? Any responses, guys, yet? I hope you got my question that we are looking at when the stated rate is not equal to the market rate. What could be the result? Anyone who wants to try here? Okay, so let me repeat my question, guys. Bonds, debentures, they are generally issued with some stated rate of interest. Let's say we are talking about, let's say 6% rate of interest. What if in the market, similar securities are yielding a lesser or a higher rate of return? Let's say 5% or 8%. My bonds, my debentures are issued at 6%, but in the market there is an 8% interest. Will that impact on my issuance of the debentures? Someone says profits, loss to the debenture holders. Shubham says loss. Ankit says profits. Syed says low rise of funds. Okay. Yes, I'm sure everyone has heard about sometimes these securities are issued at a discount or a premium. Now, of course, now I think many of you are using the word profit or loss, but I'm using the more technical term here, discount or premium. Because if market rate is higher than what you are offering, you might have to issue a discount and vice versa. But anyways, that is just for your knowledge. You guys should know, what would be the differential impact, right? Okay, what are the other okay, so I think there was a very interesting reply coming in the Q&A. Public will choose deposit which have high rate rather than debenture. Absolutely agreed. And that is why probably if you want to issue your security, you may have to give some discount. That is what I was explaining. Okay, so then we are talking about, of course, the maturity period, the duration I've already talked about. Redemption value is very important, guys. At maturity, at what value it will be paid off? Generally, it could be the face value unless given something else. And one more thing is, we are talking about a tax shield. Now, what is this tax shield? Tax benefit of the interest here. That means we are paying the interest on these bonds. That interest is a tax deductible expense. When I say that interest is a tax deductible expense, we are looking at a scenario where there will be a saving in the tax because of the interest, and hence we are using the word tax shield. Shield means savings. So let me take an example for you guys for the same. So let's do one thing. Okay, so I'm talking about two scenarios here, guys. Two particular scenarios. Let's say we have a scenario A and a scenario B. Both the scenarios have a capital 2 lakhs. Let's say in the first aspect, we are looking at an equity 100%, and debt, of course, nil. The second scenario, we are talking about 50% equity and 50% debt. And now, let me also take an example that in each of the scenario, earning before interest and tax is, let's say, 1 lakh. Now, that means if I talk about the next step, that is deducting the interest, there is no interest here, right? But whereas in the case of second scenario, because there was 50% bonds, let's say the interest is 10%. And let's assume that interest is 10,000 here. I'm just taking some assumption to explain you this concept. So my profit before tax becomes this. My profit before tax becomes this. And hence, after that, we are talking about taxation. Let's say taxes at the rate of 30%. But if you see carefully, because of this interest, there is a reduction of tax by 3,000. So can we say this is nothing but your savings of 3,000 here? And hence, can we say that cost of debt here is 10,000 minus 3,000 is 7, guys. Hence, the 3,000 is nothing but my tax shield. That is why generally you will be seeing the formula in the upcoming slides that we multiply interest into 1 minus t. Guys, I hope everyone with me on this. Any questions so far, guys, or this concept is clear? What is a tax shield or tax saving? Any questions so far? Anyone? Okay, so I'm getting some confirmations from Darshan, Bhumika. Great, guys. Thanks. Great. So now we will be talking about the formula in terms of cost of long-term debt. And we will be splitting the understanding onto the two types of debentures. One is irredeemable debentures, guys, and one is redeemable. Now, as the name suggests, the irredeemable debentures, these are the ones which do not have any maturity life or they are not redeemable during the company's lifetime. Of course, the idea is here that probably we are talking about till perpetuity. Okay, so Manisha says maturity value and redemption value are same. Okay, no, so the idea is, Manisha, in the case of irredeemable debentures, okay, I believe your question is a generic that, right? Maturity value and redemption value are same. If you're asking a generic question, that yes, the answer is because unless I would say if you're redeeming at maturity, generally it would be the same. But Manisha, in case for any reason you're planning to have an early redemption, if there are callable bonds, then it might be different, right? Because in that case, your maturity value would have been at the end of the term and you are redeeming it earlier. That's the only exception to your question. I hope, Manisha, you got it. Suraj, we were talking about the tax savings, tax shield. So don't worry, we will touch base it again, right? We'll talk about this again. Okay. Now we're talking about the irredeemable debentures, which are not redeemable during company's lifetime. If you look at the cost of debt formula here, is I into 1 minus T upon net profit or net proceeds. So we are looking at a scenario where the net proceeds is a denominator. You need to understand what is net proceeds. Now, I into 1 minus T is the fact which I just explained, the tax saving. How come? If you see the last slide, my interest was 10,000 and we multiply that by 1 minus 0.3, we get it 7,000. So that's a tax shield I explained you, but in the denominator you see NP, that's your net proceeds. It could also be construed as market price. Now depends on, am I calculating a cost for a new issue or existing debentures? If it is existing debentures, we better use the current market price. But if it is a new scenario, we're talking about a new issue. Hence, we will definitely use net proceeds because net proceeds may involve any kind of a flotation cost as well, right? Okay. Now, T of course is my tax rate. So let's take an example for this. Now, 5 years ago, Chandi Limited issued 12% irredeemable debentures at 103 at 3 premium to their par value of 100. Current market price of these debentures is 95. If the company pays the corporate tax at 35%, calculate its current cost of debenture capital gain. So I'm giving you guys, let's say 1 minute to calculate. I'm just waiting for your responses. What do you think? What do you think the answer should be? What are the responses, guys? Once you calculate, let me know, please. So just apply the same formula. I think the trick is to understand whether we are calculating the cost of debt for a new issue or an existing issue. But I think that is clearly evident when they say 5 years ago, right? That's the key part when they start. In that case, probably they're talking about the market price to be used, right? 95, I guess. I can see a lot of answers coming in 8.21, 8%, 7.8%. Someone is asking me the debenture interest rate. I think 12% they gave, na? 12%. Right? 12% it's given in the first line. Issue 12% irredeemable debentures. And you also have the tax rate also 35%. So 12 into 1 minus 0.35. I think majority are giving me answer 8 point something. So it looks good to me. So we're looking at 12 into 1 minus t divided by, now this is important because this is an existing debt. We are looking at market price and hence we are saying 8.21% is the correct answer, guys. I think maximum students gave the correct answer. So good job. Some had a calculation issue here and there. Just please double check your calculations, guys. In case you took the correct denominator, that should be a 95. Okay. Moving ahead, now we talk about the redeemable debentures. Now, if you look at redeemable debentures, that actually would map the most practical scenario where debentures may have some maturity period. That is, they can be redeemed either at maturity date or even earlier. They have some specific life, right? So here, I think the context entirely depends on how do I spread the overall cost over the life of the debenture. And when I say overall cost, it may not only involve interest. Why? Let me explain that. So let's say at the time of issue, you had some, let's say, a flotation cost, or let's say it was a premium or discount. At the time of issue, you received 98 rupees, whereas at the time of redemption, you are redeeming at maturity value 100. So that 100 minus 90 is also cost. So we are talking about two aspects of cost here. Wherein we are looking at interest and also any difference between redemption value and net proceed. That also gets scattered or accumulated over the life of the bond here. Now we are talking about an approximation method here first. And first section, which kind of talks about is where the interest is tax deductible, which generally is the case. I think most of the cases is fall under this only. Okay, so there's a point. So we are saying that by using net proceeds, it's understood, but how cost of debenture is affected by current market price for organization. Okay, Himanshu, if you remember, I think 5 minutes back we were talking about variation in the discount rate, right? Market rate. So sometimes what happens is that if you're looking at the valuation with respect to a particular market prevailing rate, you really want to decide that, okay, for any reason, the company may want to redeem it earlier or wait till maturity. And of course, the rate fluctuation can also result in the market price. See, anyways, we are talking about cost of debt for existing scenario. Now, when we're saying existing debt, now, don't forget the idea to calculate the cost of debt would have been also probably to invest, let's say, in any kind of a proposal, let's say capital busting evaluation. And in that case, generally, you would want to know that, okay, what is my current cost of capital? Are you getting it? And hence, if you were to redeem those bonds at that particular time, you would be using that market price. I think that should absolutely justify that answer, I guess. Himanshu, I hope you got that point. Anyways, a very, very good question though. Okay, moving ahead, we were talking about, okay, Darshan says that does that cost represent a cost for a particular year or cost incurred? Okay, Darshan, I think I simultaneously answered your, because what's happening here is, if you're talking about the cost of debenture at the time of new issue, of course, you're talking about at the time of new issue. But if I'm talking about calculating the cost of capital for any kind of evaluation, for that I'm calculating cost of existing debt that will be valid for that point of time. Now, the cost of capital, one may say that, okay, you may not be calculating the cost of capital, of course, for every year, but in case you are still calculating, of course, you have to consider the parameters at that point, right? So Darshan, I think again a very, very good question. But yes, the answer is that, of course, at the time you are evaluating, if it's a new issue, you take those prices. If it's kind of a just a calculation of cost of capital for any other decision, you take the market price at that point of time. Okay, so what is the formula here? So generally the interest portion is tax deductible, and we have all learned that. So look at the formula here. Cost of debt is equal to I into 1 minus T. Now this section takes care of the interest cost element, of course, net of taxes, because there is a tax shield. Whereas there, as I said, there are two costs. One is interest and other is any differential between the redemption value and net proceeds. Now that is also allocated over the life of these debentures because they are anyways having a maturity date. So you can see the denominator also incorporating an average element. I will come to that. So let's focus on numerator first. I into 1 minus T, interest cost net of tax. RB minus NP, that's the differential. That differential is spread over, divided by N. That differential is spread over the life of the debentures. So we're taking that as a part of the cost of the debenture itself. If I see the denominator though, that cost is spread over average amount, as in redemption value and net proceeds. You may have got some different amount, you may be paying something else. Average throughout the life is what it is spread on. Hence, we just need to know the formula and of course the logic behind that. And I believe the abbreviations are self-explanatory here. So I is your interest payment. Net proceeds would mean net proceeds for a new issue, but for current or existing debt, it's a current market price. And of course, N is your, now this is interesting. And I think this is also probably, if I say, Himanshu, to your point, Himanshu, the question you raised earlier, if you see the meaning of N here, we say that, okay, it's a life of the debentures, but there is a prefix, right? A remaining life of debentures. Now, if we are looking at the beginning, at the time of new issue, it may be the entire period, entire maturity life. However, if we are talking about existing debt, then this remaining word would be very important, right? So, so remaining life of debentures, and T is of course your tax rate. Hypothetically speaking, guys, if by any chance due to some tax changes or tax rules, if we say that, okay, apart from the interest, the premium or discount is also tax deductible. Remember, I told you the net proceeds may be different from redemption value. There could be premium, there could be discount, there could be flotation cost. If those are also tax deductible, what you do is you take out 1 minus T from I and you apply this tax savings on the entire element of the cost, interest also, and that differential also. So 1 minus T is applied in both the cases if this is also tax deductible. I hope that makes sense to everyone, guys. With that, let's kind of focus on this illustration on your screen. A company issued 10,000, 10% debentures of 100 each at par on 1st April 2012 to be matured on 1st April 2022. Now, company wants to know the cost of its existing debt on 1st April 2017. Be careful of the dates, guys. Cost is calculated on 1st April 2017 when market price of debentures is 80. And they're requiring us to calculate the cost of existing debentures, mind you, not new, of course. So there are more than one hint here. And tax rate is 35%. So let's see what are the responses we are getting here. Giving everyone 1 or 2 minutes. Please calculate and let me know. Already getting some answers. Amazing, guys. This is always good, guys. So excitement level, energy level, super high from the very beginning. Received answers from Jay, Ustad. Wow. Also getting some answers from Rajiv, Madirala, Syed. Till now, I think I got two answers, but one is majority. So majority, if you're giving me answers as 11.67%, I guess. So what have you done? I believe you guys are using a market price for net proceeds 80. And then we are looking at a maturity price. That means 100 here. So that spread is 100 minus 80. That's important point here. 20 here. That divided by remaining life. So mind you, 2012 to 2022 was 10 years, but they're already 5 years ahead in 2017. If we are talking about debentures here, 2012 to 2022, we are already somewhere here, guys. We are already 2017. So the remaining life is 5. So 100 minus 80 is kind of divided by that 5. And you can see the interest element, of course, 10 net of tax, that is 1 minus 0.35. So that entire is divided by average of the investment or average of the values. That's your 100 plus 80 divided by 2, that's 90. And hence, the majority is absolutely correct, guys. Majority is absolutely correct. So till now, the fashion or the trend is that the majority of the students are getting it correct. That's amazing. Now, the people who got 10.56 or probably 8.12 or even one student got a 9.4, please check. Please check. Some of you might have missed the remaining life point. That could be also one reason, right? So remaining life is 5 years here, not 10 years. Because we are in 2017. Everyone okay, guys? Everyone okay? Any questions? I hope everyone is clear now. Okay. So moving ahead, we are talking about the most recently common method, which is being very much frequently tested now also. That's cost of redeemable debentures using YTM. Now, mind you, the last slide I mentioned that we are talking about approximation method, but now this is more practical and very much tested also, YTM method. Now this is we are talking about a yield to maturity. Now, because thankfully we have a maturity, what we will do is we'll discount the cash flows using some rate, which would be IRR. And when I say IRR, that means IRR is a rate where is the NPV and NPV is 0. That means your present value of inflows and outflows is equal here. Sayed says, is there any example for discount or premium? Okay, Sayed. So as I already said that practically you will always see interest being tax deductible. But in case premium it is, you don't need to do anything else except for applying the tax benefit to the total of the two numbers, right? Interest and also the difference in redemption value, and then it proceeds. Now, coming back, so you're saying that yield to maturity method requires discounting of cash flows. And when I say discounting of cash flows, we are looking at a particular rate, which is a IRR. That means at that rate, my inflows and outflows discounted values are equal. And that means NPV is 0. Right. So the idea is we are looking at yield to maturity. And this is a IRR at which the current price of a debt equals to present value of all cash flows. Now, can anyone tell me what do you mean by this? Like, we are looking at current price of a debt is equal to the present value of all cash flows. That means, do you agree with me? Probably the resulting discount or premium could also be, calculated using the same method. What do you think? Because we are talking about a rate at which the current price equals to the present value of the all cash flows. So that means if we are talking about a rate which is a market rate and it gives me the equal value, that means generally you are talking about no premium or discount. But yes, if the cash flows are a different rate, then of course premium or discount could result in. But anyways, let's understand this method first. So what are the relevant cash flows? Relevant cash flows in case initially is a net proceeds in case of a new issue, but in case of existing, it's a current market price. Your during the tenure or the remaining life, that's your interest, is a relevant cash flow, but mind you, net of tax. And then at the end of the life of the bond, we are looking at a redemption value. The Darshan says the market price would be keeping on fluctuating, hence the cost of debt would also different for each period. Darshan, I think this is the same question someone asked earlier, right? So we are calculating it at a period of time. So if you're calculating existing cost of debt at multiple periods of time, of course, you will take that particular time's market price. Okay, so how to calculate the relevant cash flows? Now, I think we know that initial net proceeds, we're talking about interest, and we are also talking about redemption value. So let's take an example here, guys. Now, company issued 10% debentures of 100 each on 1st April 2013 to be matured on 1st April 2018. So we're talking about 5 years here. 5 years. Okay, Karthik, we will be talking about yield to maturity method again and again. So don't worry. Through this example, I will also explain how to calculate. Okay. So don't worry about that. You're not missing anything as of now. And I will check with you again once we are done with the example, whether you got it or not. So the company wants to know the current cost of its existing debt and the market price of the debenture is 80. Compute the cost of existing debentures using or 35% tax rate. Now, I have a very, very logical interpretation here. We are saying that the debentures to be matured on April 18, and they're asking you the current cost of existing debt. And the market price is 80 here. And if I were to calculate YTM, I will be actually calculating a rate at which there is a zero NPV. That means your current price is equal to the discounted future cash flows. So that means if I want to identify the relevant cash flows as a very first point, we are looking at the current price, that's 80. We are looking at the redemption value, that's 100. And of course, there is an interest, right? 10% debentures. But mind you, I told you that this is net of tax. So interest is 10%, that is 10 into 1 minus 0.35, that is 6.5 is my interest. Now, we have to calculate the NPV. Now, this is, guys, I want everyone to be careful here. This section, all of us, will again touch base when we talk about investment decisions. Around about a couple of weeks from now, when we talk about investment decisions, we will be studying the same formula when we talk about IRR. So you look at this, we are actually calculating. So let me actually show you this working, guys. Just give me a second. Okay, right. So guys, I hope you guys can see the working on my screen now. Now, what is the cash flow initially? Now, mind you, this is an existing debt. So year zero, mein the cash flow is 80. And then you're paying interest and principal at the end of the life of the debt. So interest, we just calculated net of tax. So we're looking at interest net of tax, 6.5. And the maturity, you're talking about the redemption value of 100. Now, what you need to understand is that since we are calculating IRR, so we will be just reversing the signs, as in when we are talking about the initial cash flow, mind you, also we discussed that, okay, this is from an expectation of the provider or the investor. And for that person, it is the initial outflow, and later on that person will be receiving the interest and also the redemption price. Now, I hope everyone is clear here how to calculate the discounting factor. Like for example, we are looking at this as a present value annuity factor here. Now, what is this? So let's say we are talking about 1 upon 1.0 is 0.909. 1 upon 1.10. This is, let's say, 0.826. And accordingly, we will be calculating the 1.105. So whatever the 5 factors, when we combine them, we're calculating a present value annuity factor 3.791. So because the interest is constant across the 5 years, we are able to use an annuity factor because interest is same. And then for the 5th year, we are using 0.621. That's a present value factor for the 5th year. We multiply that with all the cash flows and we're getting a positive NP of 6.74, guys. Now, hold on. I want to go back and talk about this formula a little bit more. We are calculating an IRR under YTM method. We are calculating an IRR where the current price of debt is equal to the present value of the cash flows. Now, in case we directly find out that rate, it is amazing. You can use that rate, but very seldom that happens. So what we will do is we will calculate the NPV at 2 different discount rates. So one will give us positive NPV and 2, we are talking about a negative NPV. Guys, I hope this is okay. Himanshu is asking full form. IRR is internal rate of return, Himanshu. Rate at which my NPV is 0, net present value. Right? Now, I'm saying that I need 2 NPVs. One is positive, one is negative. I have a question to you guys. If let's say I take a random rate, random first rate, and it gives me a positive NPV, what should be my random second rate? I think quite a while I did not ask you guys a question, so that's for you guys. That if my first random rate is giving me a positive NPV, what would be the second random rate? Or how do you think about a second random rate? Because you're anyways not aware of any kind of a rate here. So giving you 1 minute, guys. Think over and answer. Sayed, yes. So discounting rate is what we are taking. So first we are taking one discounting rate. We calculate an NPV. And then we see that, okay, if it is a positive NP and negative, as I said, we need 2 NPVs, one positive, one negative. Now, very interesting answers. Okay, Bhumika, H and L is higher rate and lower rate. H is a higher rate, L is a lower rate. Okay, I think a lot of you are giving me higher, negative, less than first rate. Okay, so it's like different answers. So guys, if my first rate NPV is a positive, how do we calculate NPV? Your NPV is by discounting it, right? So let's say my cash flows into 1 upon 1 plus r to the power n is giving me positive, then for a negative one, my rate has to be increased now. My rate has to be increased. For a second rate, I will have to keep a higher rate to come up to a negative NPV. So random second rate has to be higher so that it can give us a negative NPV. It has to be a higher rate because see, if you are dividing by a higher number, your result is a smaller amount. And hence, you probably come across a negative. Now look at my example case. I've taken the first rate as 10%, which gives me a present value of 6.74. It's giving us a present value of 6.74. Whereas then I take another random number, which is a higher number then. Why? Because my first NPV is positive. I have to take a higher number. 15% pay. We are looking at present value, which comes out as a minus 8.51. Now that this is exactly what I said. That means my IRR is somewhere between 10 and 15%. Somewhere between these two numbers, guys. So now you will understand this formula very easily. IRR is equal to L. L means lower rate. In this case, my lower rate is 10, guys. Plus NPV at lower rate, which is 6.74. And I want everyone to focus on the denominator. In the denominator, we have a NPV at lower rate minus NPV at high rate. But mind you, NPV at high rate is already into minus, guys. So do you agree that it will be minus minus plus in the denominator always? Do you agree with that? That in the denominator will be minus minus plus? Any thoughts, guys? Are we looking at a minus minus positive? Because we have a positive NP and a negative NP, and negative NPV would be at a higher number. So, and we multiply this between the difference of the two, 15 minus 10, and then we are getting 12.21%. So that rate, you can see the definition of the IRR here. It's the rate where your present value of cash inflows is equal to the present value of cash outflows. Okay, so this is a very, very interesting method, guys. Very commonly tested these days. So make sure that you get your hands dirty on this. You need to practice a YTM method based question, guys. Now, one more aspect I would like to talk about in cost of long-term debt, which is a value of a bond that's amortized or repaid in installments, guys. That means like we sometimes have different type of bonds. Let's say we have serial bonds. Let's say we are talking about serial bonds where bonds are matured in installments or as per the serial numbers. Now here in the installment cases, or the bonds are repaid in installments, we're saying that outstanding principal will be reduced as the annual payments are made and interest will be computed on the outstanding amount. Outstanding principal will be reduced because you are repaying the bonds partly. Interest will be, of course, computed on the balance amount because my principal is getting reduced. So how do I calculate my value of that bond? Look at this, C1 upon 1 plus KD, C2. Now, every year's cash flow is kind of, we are talking about a different number because interest would be on a lower number here. There would be an outflow also. So let's understand, how do we calculate the value of a bond? Mind you, we're not talking about cost of debt here, value of a bond for something which is paid in installments. So let's look at this example here. Syed says, Syed has a question on my last slide that how do we say that IRR is between 10 and 15? Syed, I hope you agreed that on 10, you're getting a positive NPV. For a negative number, you need to have a higher NPV. a higher rate, right? For a negative NPV, you get a higher rate, higher than 10%. It could have been 13 or 14 also. Now, since at 10%, my NPV is 6.74, since at 15%, my NPV is -8, don't you think it has to be somewhere in the here where my NPV is 0? And that's why I said between 10 and 15%. Sayed, I hope that is clear. Okay, let's move on to the example of the value of bond that's amortized or repaid in installments. So M&M is proposing to sell a 5-year bond of 5,000 at 8% rate of interest, and bond discount or bond amount will be amortized equally over its life. So equally means 1,000 every year, right? So we're looking at equally over its life. Calculate the bond's payment or present value of all the payments if he expects a minimum rate of return of 6%. So guys, every year we are looking at 1,000 per annum. And of course, my interest will keep on declining as I pay off. Ustad, I'm pretty sorry that I would not be reinstating that in Hindi because everyone would not understand Hindi. Please, try to practice YTM. I'm sure you will find it easy. Don't worry, we will talk about in the same in some practice questions also. Sayed, again, it approximately will come you to the same answer because if you take it 13 now, your negative present value may be, let's say, -1, -1.5. Sayed, your NPV may not be -8, but it may be -1 or something like that, -1 or -2. It's kind of a logical, right? So some of you are still asking me a question on YTM. So let me show you a number line here. I'm creating a number line which says or IRR or a rate. Let's say talk about this. We call it as a rate. So here it is 10%. Here it is 15%. And we are looking at NPV. At here it is 6.74. At here it is -8.51. Now someone said that we may need, what if we take a 13% here? In that case, you can very well imagine that if we take NPV, it may be around -1.8 to whatever. I'm just taking approximately here. Of course, you can calculate using the 13% present value. Yeah. So the idea is then if you take about 10 and 13, your answer will be still 12 point something. It may not be exactly 12.21, but it would be something 12 point something only. Right. So I hope that is kind of Syed, thanks for clarifying your doubts. I always request students that please ensure that you kind of get your doubts cleared when it comes. Okay. Okay. Shubham says that when we say 10% debenture, isn't our cost of the debenture 10% only? Okay. Shubham, 10% is the interest you need to pay, right? 10% roll is only as a coupon rate. That's it. Remember when I started our discussion, let me go back some slides. When I started this long-term debt aspect, I was explaining you the word coupon rate. That 10% debenture just means that it's a cash payment. Actual cost would be after getting the tax impact. Actual cost would also be depending on the market rate of interest. Actual cost will also be dependent on the differential between the redemption value and the net proceeds. So there are factors. So you can't just say that, okay, if it's a coupon rate, that's the cost. It may or may not be. It may or may not be. So Shubham, I hope that gets your doubt clear. So let's come back to the illustration, guys. So M&M, we are talking about a 5,000 bond payable in equally over its life, right? So 1,000 per annum, and your rate is 6%. So let's see this. In this case, My opening outstanding is 5,000. And since it's a 5,000, I'm calculating the interest. Mind you, it's a very, very interesting aspect which I want to highlight here is and I think Shubham, this question can also answer your point, right? That you're looking at a bond which is a coupon rate of 8% here. That means cash payment will be 8%. But mind you, since your hurdle rate is 6%, so you will be discounting at 6% here. Discounting will be at 6%, but coupon rate is 8%. So you can see that interest is paid at 400. Principal is 1,000. So we're getting a 1,400 being discounted at, now look at this, 6% here. Look at this, 8% here. So 1,400 discounted for 1 year at 6%. Second year after paying 1,000 as a principal, your interest goes down and hence your total outflow is reduced. So is for every year. So every year your outflow is reduced and you're calculating the present value. And in this case, the value of the bond is 5262. Okay. Interestingly, if forget about this question, guys, and this is exactly what I was explaining you, what happens when the market rate and the stated rate is different, right? I told you that it may result in a premium or a discount, right? Darshan is asking what is discounting. Darshan, discounting is something, let's say, we're talking about an amount 1 year later. What will be its value today? So for example, you are investing 100 rupees in a fixed deposit today at a 7%. Tomorrow you will get 107. So if I discount 107 today, I will say 107 into 1 upon 1.07, I will get 100. So today's value compounded to the tomorrow's value or tomorrow's value discounted to the today's value. That's how we call it as. So Darshan, I hope that is clear. Now coming back to my point, I was explaining you that, okay, what happens where the coupon rate. Now this is a classic example. I say that my coupon rate is 8% in this question. And I say the hurdle rate would be, of course, their expected rate, right? Or it could come from a market rate of 6%. Now, anyone can conclude that if I am offering a bond which is higher than 6% interest, I'm paying a bond which is yielding you a higher interest than anywhere else in the industry. Don't you think I will ask you some premium on it? I will ask for some premium on it. And hence, the value of this bond would have been more than 5,000 anyhow. So we are getting 5262. That's a good checkpoint. That's a good checkpoint. That it's anyways coming to be more than 5,000, guys. Right? So that's the logic we need to know. Great. We also talk about cost of convertible debentures. Now, this is a very interesting aspect. Wherein we are talking about holders have an option to either get debentures. Now, mind you, this we are looking at a convertible. What is convertible? So either we are looking at the debentures redeemed to cash, or other option is to get specified number of shares in lieu of cash. That means we are looking at redeemable debentures. The only thing is they can either be redeemed into cash or by some shares. Right? So this is also a similar aspect to redeemable debentures. The only assumption, and I think this is the logical assumption, anyone will say that whenever in life you are posed with two options, you will always go for that option which is more beneficial for you. So we say that the assumption is the holders will choose the option with a higher value. If the cash is higher than the market value, or let's say or the market value of the shares, you may go for the cash. But if the shares value is more than the cash, you will go for the shares, guys. So assumption is that all holders will choose the option with higher value. So thus the redemption value shall be the value of shares at the time of redemption. Accordingly, the redemption value will be decided. So let's take an example. A company issued 10,000 15% convertible debentures of 100 each. Maturity period is 5 years here. Now, for me, The key point is this one. The debenture holders will have the option to convert the debentures into equity shares in the ratio of 1:10, that is 10 shares for one debenture, and the current market price is 12 each. And the growth rate is 5%, guys. Now we have to compute the cost of debentures assuming 35% rate, guys. So who will tell me how do we go about this? Any thoughts? I already explained you one important aspect, that these are similar to cost of redeemable debentures. So nothing different. So you know the reason and the formula here, when we calculate what the cost of capital for redeemable debentures. So apply the same formula here, guys, and give me the answer, please. Said there has to be some calculation error. So or if it is just marginally here and there, you can ignore. But if it is deviating, you can check that later on, please. Okay, so right now, can we focus on this question on the screen? I want you guys to give me the answer applying the same formula we discussed for redeemable debentures. Hence, we are looking at that I into 1 minus T formula. Okay, Darshan has a very interesting point. Go on with the difference between the interest rate and the growth rate of the shares. Very good. I think the starting point will be that you need to calculate the redemption value, guys. Now in this case, the redemption value is that either you get your, the redemption option is that either you get your redemption value of 100 or a maturity value, or we are looking at option of conversion in the price, right? So we are looking at 12 per share. And if you're talking about 1.05, and this is, we're looking at a 5 period, right? 1.05 to the power of 5. What is this? Can anyone tell me? 12 into 1.05. I think we're all getting 15.31 or 15.32. So getting 15.32, and we are looking at 10 shares for each debenture. That will be into 10. So we are getting 153.2. So guys, so this is on the premise that is the information given to us in the question, that the current market price of equity share is 12 each and the growth rate is 5%. So what will happen after 5 years? So after 5 years, that value would be 15.32, and hence if I convert my shares, my debentures into the shares, my conversion will give me 153.2. So 15.32 into 10, because that is what the conversion is, right? Conversion ratio is for one debenture getting 10 shares. So 153.2, guys. Now that is my question. Are you going for a redemption cash amount of 100 or a shares worth 153? What will you do? Guys, the first step in this case is to calculate the redemption value. That's what we're calculating here. Is the redemption value 100 or something else? I think I would go for 153, right? Anyone would go for more than 100. Now, God forbid, this share price versus the number of shares would have given me a lesser amount than 100. I would have opted for 100 then. Guys, everyone with me on this? If we are looking at a cash price of or cash value of 100, and the conversion would have given me the shares worth less than 100, I would have opted for cash. But now it is giving me a shares worth 153. So that will be my redemption value, guys. And since we are getting 153.12, that means that becomes my redemption value in the same formula. I into 1 minus T plus redemption value minus net proceeds upon 5, and so on. So you're getting 16.09%. I'm just giving everyone a minute to just take a deep breath. Let me know if there are any doubts in this particular example. Any doubts? Any doubts, guys, or everyone is clear? Thanks, Darshan, for confirming. And what about others? Great, amazing. Thanks, guys. Thanks for confirming. Now, with this, we kind of start our discussion with cost of preference shares. Now, that's the second element we are talking about, cost of preference shares. Now, in this regards, we understand that yes, like the debentures, even the preference shares are generally paid a dividend, unlike the interest though, which is a percentage of the face value. Now, the only thing is that it's not a mandatory, but of course, whenever the dividend gets declared, these guys definitely get a edge or a priority over the equity shareholders. Sudhanshu is asking KD. Sudhanshu's KD is cost of debt. We are calculating cost of long-term debt, right? So cost of debt. Shubham says growth rate is 5%, but it's happening over 5 years. So why we are considering that value in present? Okay. So Shubham, again, we are comparing apple versus apple, right? We're comparing apple versus apple. Like we comparing 100 also would happen 5 years later. So would you be opting 100 then or 153 then? Right? Okay. And I think we are anyways calculating. Okay, Shubham, we have a very, very interesting point. I also want to mention this very interestingly that where you are heading towards is discounting amount, right? You're talking about time value of money. Mind you, Shubham, you're already into it. You're calculating cost of debt, which will be used for calculating WACC. And that WACC, cost of capital, will be used for discounting the evaluation proposals. So we are not discounting within the discounting, right? It's a very good question though. Okay. Said says 153.12 is value of shares and redemption is for bonds. Said, because I think you saw the illustration, I hope. You have the option to convert the debentures into equity of 1:10. Was that the option? Am I correct? So that means either you receive 100 or you receive 150 shares worth 153, so that you can sell in the market. So you will definitely go for 153. Yes, Bhumika. So whichever is beneficial for you, I would say. The answer is yes. Okay. Any further questions, guys? Okay, great. Now coming back, guys. So I was telling you guys that yes, dividends are kind of paid on the preference shares, which are not mandatory, but they get a priority over the equity shareholders. One more thing, that since dividend are not tax deductible expense, they are appropriation of profits. We are saying that it's not tax deductible. Hence, if I'm talking about cost of redeemable preference shares, it is a very similar formula, but you will see there is no tax element here because dividends are not tax deductible. So you say cost of preference shares is the same formula, thank God, is preference dividend plus RV minus NP upon N, that is the remaining life, and then upon the average. Now, same fundamental, same formula here. Redeemable preference shares, very, very similar to the debentures. The only thing is they are not tax deductible. So hence, any 1 minus T here is not needed. It's not needed. So we're looking at, again, the net proceeds could be for new issue. The current market price could be for existing. Again, the net issue or the net proceeds would be less any issue expenses. And again, if they're not giving you the issue expenses and that or the issue price, and they're asking you for the the new issue, in that case, probably you have to just assume that okay, it's equal to the current market price. Okay, Bhumika says if I convert my debentures into shares. Okay, Bhumika, I think again your question boils down to the fact that we already chose that we'll go for a beneficial one, right? Because if you had not chosen that 153, you would have chosen 100, your cost would be less. Your cost would be different, right? So we are calculating that 16% in that last example, Bhumika, based on that premise. If I change my redemption value, my answer will change. Okay, I hope that makes sense. Okay, so coming back to the example here, I was talking about, guys, this cost of preference shares, specifically the redeemable preference shares. Let's take an example. Zenith Company issues a 1010% preference shares of 100 each at 96 value, and the company proposes to redeem them at the end of 10th year from the date of issue. Calculate the cost of preference shares. Mind you, we are talking about a new or a existing. It seems to be the new one, right? So net proceed is 96. Redemption value is 100 here. And how much is the dividend, guys? 10. So 10 plus 100 minus 96 divided by the 10 divided by the average amount 98, it gives us 10.61. Quick confirmation on the example. I think the best part about this is cost of redeemable preference shares. The best part is that it is absolutely same as debentures. The only fact you need to be careful about is that this is not tax deductible. So don't apply any tax benefit by any chance. No tax benefit, guys, here. Everyone okay, guys? I hope this is making a kind of a continuity what we did earlier. Okay, so that is about your cost of redeemable preference shares. So let's do one thing, guys. It's almost 7:20. So let's take a 10 minutes break, everyone. I think we all need a breather, quick breather. Once we come back, we will be continuing the cost of irredeemable preference shares, and then we'll be moving on to the cost of equity and other components. So I think good time to take a break. So let's resume in 10 minutes, guys. See you then. Okay, so guys, welcome back. I hope you all got refreshed. Very much fluent and continuous traffic-oriented session first half, and pretty much enjoying the same with your responsiveness, guys. So I think that's what I would expect from all of you to be, keep on the chat box active and ensure that you kind of clarify everything what you need, right? So that makes the momentum also going ahead. So we resume our discussion from the cost of preference shares, specifically the irredeemable now, right? So in this case, like we are saying, it's irredeemable and no maturity value. And specifically when we say that, okay, it's kind of a part of equity, if not equity shares, but yet we are looking at in terms of calculation of a perpetuity cost. So what you do is you just take preference dividend and you divide it with either the net proceeds or the market price, depending on if it's a new issue or the existing issue, right? So existing one. So we are talking about preference dividend upon the proceeds. Now that means it's just a cost. We are kind of calculating based on the preference dividend, whatever may be required to pay every year. So like an illustration in front of you, which says if Synergy Inc. is issuing preferred stock at 100 per share with a stated dividend of 12% and a flotation cost of 2%, then what would be the cost here? So it's as simple. We are looking at a 12 upon a 98. Pretty simple one, isn't it? So just remember, irredeemable, we are looking at a perpetuity cost, right? So now, guys, we move on to the agenda, which will be a very, very important aspect here. Before even we go to the weighted average, the last element here, which is a cost of equity share capital. And then we, of course, we will be also talking about retained earnings, but this section is very, very important. Now, as we already knew that, okay, cost of capital is the expectation of the investors. In this case, it's the equity shareholders. So we're looking at the expectation of the equity shareholders in terms of what are the returns they get. Okay, Himanshu says, what are the flotation cost? And so is Sudhanshu. So guys, flotation cost is the cost which you may be incurring in terms of, let's say, brokerage or commission, the cost while issuing the securities, right? So that's your flotation cost. Any brokerage, any commission, any issuance related cost, underwriting cost, all those are part of the flotation cost. So as I said, in terms of the equity share capital, what is the expectation of the equity shareholders? Now, mind you, generally, the equity shareholders would be interested in overall growth because they know that the entire amount the company is earning as profits may not be distributed as dividend. And in that case, if I say that, okay, if some part is distributed as dividend, other part may be retained as retained earnings, you would want a growth overall. So you're talking about not only the return in form of dividends, but also in terms of overall growth in terms of reinvestment. So there are different methods we are talking about to calculate cost of equity share capital. However, we will be looking at couple of methods as more important than others, more heavily tested. So we have a dividend price approach, earning price approach. We have a growth approach, a very, very important one. We have a realized yield approach. We have a capital asset pricing model, again, a very, very important one. So I would say a dividend growth model or a Gordon dividend model, also another name for that, and the capital asset pricing model are the two most important ones here. Although for understanding purposes, we will also look at other three methods and you will understand yourselves that why other three methods are not preferred because they have some drawbacks which are quite understandable, right? So let's start our discussion with the first couple of them, right? We're looking at firstly the dividend price approach, dividend price. Now look at the assumption here. It says that the dividend per share is expected to remain constant forever. How can it be? How can it be? So we're saying that D upon P0, that's it. So it's an expected dividend, but that is expected to be constant as well. So that is definitely not a common method. We need to know that, in case there is a theoretical question to kind of comment on different methods, you may know that, but yes, not at all practically, relevant. The next is the second one on the list was earning price approach. In this case, we're saying that the key word is earnings, of course. And of course, the name itself has the formula earnings upon price. So probably EPS upon the price, earning price. So let's say we are saying in this case is based on the premise that investor expects a certain amount of earnings, whether distributed or not. You're saying that, okay, earnings price is kind of, based on certain expected amount of earnings. And moreover, we are saying that we are assuming that earning per share will remain constant. Now, what was the assumption in dividend price? The dividend will remain constant. Now, we are seeing another assumption. Earning per share will remain constant. Both the assumptions are quite easily challengeable. Here also we are talking about an assumption which kind of may not be practically relevant. Again, the formula is earnings upon price, which is EPS upon the net proceeds or the current market price. Okay, Suraj, yes, I think, of course, once you go through again and again, you would be automatically, getting formulas acclimatized. If you're going through it for the very first time, of course, it is not easily, kind of memorizable, a lot of stuff. But that is why we kind of, we always do a review of the courses once we are done, right? So we have to do the review, revisions, whatever you call it, and then you will find these formulas very easy. Don't worry. I think it's a little bit of a initial fear factor. Look at Preetham. So Preetham, Suraj, all coming with, how to know all these formulas, man. How to know these formulas. As I said, I started the session by saying practice, practice, and practice. 3 keys to success. So don't worry. You're doing the course. We are going through this for the first time. But as a student, I'm sure you will do a repetitive study, and that will help you to cement it. I don't know if you guys have ever watched a house being constructed. What happens when there is a linter? When there is a linter, when there is a roof being laid down, it's quite a mixture of cement, reta, and other stuff. But immediately after the day the linter is done, it's complete. Have you seen the workers watering the surface on the top, and they keep water for some time? We also call it as a word called in Hindi called tarai, right? So probably you need to apply the same logic in your preparations. While we are, kind of together here in our lectures, we are basically building a roof for you. You are the one who have to water that. You are the one who have to practice that and do some reading. I hope that makes sense. Okay, question coming in from ex-dividend perspective. Okay, so Danshu, ex-dividend is basically when we are talking about a market price where market price on the date where the share is no longer eligible for any dividend, right? So cum dividend is inclusive, ex-dividend is exclusive. Okay. So we're talking about a dividend price and earning price. We move on to a small example on the earnings price approach. So let's see if you guys can quickly participate in this one. A firm is considering an expenditure of 60 lakhs for expanding its operations. Relevant information is given. Number of existing equity shares, 10 lakhs. Market value of existing share rupees 60. Net earnings 90 lakhs. And we say compute the cost of equity share capital and of new equity capital. We're talking about two things, existing and new, assuming that new shares will be issued at a price of 52 and the cost of issue, the flotation cost, would be 2. Okay, Himanshu, don't worry. We are not even talking about, we are looking at accounting different as a financial management. So when we say dividend, we are not going for the timing of the dividend, whether it's an interim, final, proposed. We are not going to do that. We are talking about the total dividend, irrespective of the category. Okay, so yeah, so I'm waiting for some responses, guys. So this question has two parts. One, we are looking at existing equity share. So who will tell me cost of existing equity share using earning price approach? Mind you, the formula here is EPS upon the market price, or you can use the net proceeds as well, depending on. So let's see who answers first for cost of existing equity. Probably the only hint I can, give here is your robot existing or new, right? So, your denominator will change accordingly. So, so we're getting cost, right? So some people are telling me 1.5. Some people are telling me 15%. So guys, cost probably, I think I would prefer the answer in percentage, of course. Some people are saying 0.15. I think just mention that in percentage. Okay, so I can see that. Okay, so some people are applying D upon D0 plus G. Don't apply the growth model yet. We are about to discuss that. Chinmoy, we are not even reached there. So we are just talking about earning price approach. So I think majority for giving me 0.15. So I believe what you're trying to do is you're calculating earning per share. That's okay. So net earnings is 90 lakhs divided by your number of shares is 10 lakhs. So 9 is my earning per share, right? Now, if I'm talking about existing equity, that means probably you're looking at a market price. So 9 upon 60. So that means it will be 15%. But if you're talking about the new equity, right? New equity, then your denominator would be 52 minus 2. So that would be 9 upon 50, guys. So it's like 15% or 18%. Pritam, I don't know why and why you're saying 150%. Just check your calculation, please. 15%. So while looking at 15% and 18% as the answers, and I think most of you got it correct. I hope everyone okay here. Let me know if any doubts, guys. So it's 15% and 18. Okay, so moving on. I hope this is clear to everyone. We are now talking about the first most important method of equity share cost, which is called as a Gordon's model, growth model. Now, here also there are assumptions, but by the way, which model would succeed without any assumption? There has to be assumption, right? I hope you guys remember your economics earlier from schooling days. Law of demand also had a suffix called ceteris paribus, assuming everything else being constant. So yes, there has to be some assumptions behind every model, every theory. So Gordon's model assumes that dividend growth remains constant and earnings, dividend, and equity share price all grow at the same rate. Now, thankfully, I'm actually saying the word thankfully. It is not saying that dividend or earnings is constant. It is just saying that, okay, it will grow at a constant rate. Guys, are you getting this? Getting the context? We're saying that it assumes that dividend growth remains constant and earnings, dividend, and equity, they grow at same rate. So assumption is at same rate, but it is still growing, right? So the formula here is KE is equal to D1 upon P0 plus G. Now, what is this? Let's kind of settle down this formula first. We're saying D1 is next expected dividend. That means if they are giving you the current year dividend, that is D0, we multiply with that with 1 plus G. G is the growth rate. That's the constant growth rate of dividend. And of course, P0 remains the same. Current market price for newly issued shares, net of any flotation cost. In case of a newly issued shares, we're talking about net proceeds. Now, I have a very interesting question for all of you to think aloud. I am saying that, okay, the formula is D1 upon P0 plus G. Within the D1, there is already a growth rate incorporated. In D1, they have already incorporated the growth of the dividend over 1 year. Then why we are adding G here? Can anyone tell me? Why we are using this formula D1 upon P0 plus G? D1 automatically is calculated using the growth rate, and why G is added? Why is G added, guys? Let's see your responses. Just think, whatever you can think about it. Think logic, what could be the logic? Okay. Himanshu says 1G is for dividend, other G is for share price. Interesting. I will enjoy the answers, guys. I think, and I'm really appreciating that you guys are trying your best. Darshan says because shares are also expected to grow at the same rate, sir. Okay. Mind you, we are my left hand side is cost of equity, by the way, right? Not the share price. Shubham says market price is also growing, so G is also added maybe. Bhumika says because increasing at the same rate. Ustad says it is because equity is assumed at the same rate. So I think you guys are giving very consistent answers. That's a very, very good thing. Ganshu says because of dividend being paid from the beginning of the year. Okay, very good. I'm really, as I said, guys, I think everyone is trying from their best application of mind. And let me add a slightly different horizon. And that point is the entire earning distributed as dividend? Yes or no? Is the entire earning distributed as dividend? Of course, the answer is no. And I think now you will get the answer. That if we are, so the entire earnings is split into two parts. One is the dividend, other is the reinvestment. Guys, I think all of you are very close to the answer I was looking for. So one is the dividend, other is the reinvestment. So this other G, we will also look at it. This other G represents the growth in the reinvestment amount. Every investor would want that whatever the in reinvestment, whatever amount is not given to them as a dividend results in growth. And we will actually see the computation of G also very soon. So I hope you like the logic. So D1 incorporates the growth in dividend. Other G represents the growth in reinvestment. Right? So let's look at a very, very straightforward illustration here. Company has paid a dividend of 10 per share last year. It is expected to grow 10% next year. So that means my D1 is equal to 2.2 or no, how much? 10, right? 10 into 1.1. So we're looking at 11 here. And the cost of equity, if the market price of the share is 220. So we are looking at like 11 upon 220 plus growth rate is 10%. So what will be that, guys? So probably we are looking at a 15% as an answer. A 15% as an answer. This is a very, very straightforward question which just applies the understanding of the formula here. D1 upon P0 plus G. Okay, before we go to the next slide, which will be talking about G, how do we calculate G? I would like to mention another formula on the top right. And you guys need to tell me, is this formula looking correct? You guys agree with the formula here? I am giving you another formula here. If I have to calculate the market price of the share, can I say it will be D1 upon KE minus G. Do you agree with another version of the formula? This is the another version. P0 is equal to D1 upon KE minus G. Let's see your responses. So what I've done is I've taken G on the left hand side, so that becomes KE minus G, and then P0 and KE minus G are swapped. What do you think? Interesting. So what we have done is, so KE minus G is D1 upon P0. Hence, P0 is D1 upon KE minus G. So the same Gordon model being also used to calculate the price of the share. So you just be careful. They might give you some information. They might ask you something else. Right? So now understand how this G may be calculated. I told you that G also represents the part, the reinvestment. So we're looking at couple of methods here. One is an average method. Average method. Now this is more of a exponential method, which is you just need to know this. So where we're looking at a current dividend D0 is equal to how the dividend has growth n years ago. What has been the growth in the dividend in n years ago? So how the dividend has grown across the last 5 years, 10 years. Don't get confused. DN is not in the future. DN is actually the past. So D0 is the current present. DN was in the past. How the dividend has traveled today. So we are looking at growth rate is a square root or the nth root of D0 upon Dn minus 1. So don't worry, they will not expect you to calculate this considering the mathematical challenges. But just for your knowledge, you should know that this is one method called as average method, how the dividend has grown. But I think you would probably like the other method more, which I was talking about. Another method to calculate G is basically again a Gordon's growth model itself. The model itself gives you, this is much more easily calculatable by you guys, where we are saying that with some of the earnings retained, increase in the level of investment will give rise to increase in future dividends because you will have increased profit, and hence my cost of retained earnings will have a G equivalent to B into R. Now what is B and what is R, guys? B is the earnings retention ratio. Can we say it is also equal to 1 minus dividend per share, or can we say that a dividend payout ratio? So if 30% is paid as dividend, we are saying that earning retention ratio would be 70%. And R is the rate of return on funds invested. So that's the expected rate on that. So that's G is equal to B into R. Guys, I hope everyone is clear and you guys agree with me that yes, the Gordon model itself defining G as B into R makes more sense. And if at all you were to calculate, you can easily apply the formula here. That's earning retention ratio multiplied by the return expected on those funds. I hope everyone is okay. Till this point, what we have done, let's go back. We have talked about the dividend price method, earnings price approach, and growth approach. We are now moving ahead to the next two methods, realized yield approach and capital asset price. These five, the growth model and the capital asset pricing model are the ones which are more commonly tested. But yes, we need to know all the methods for our understanding. So let's see what are the realized yield approach method. So we say expected return is based on average rate of return realized in the past. You're saying expected return is based on average rate of return realized in the past. Since earnings doesn't remain stable, this is definitely not a practical one. We are saying that, okay, expected return is based on the average rate in the past, then of course we are kind of assuming the past pattern, which may not be always true. So that means the risk you had faced earlier may not be the same as today, specifically how things have changed pre-pandemic, post-pandemic. I'm sure everyone agrees to that. So shareholders, it's not necessary that may expect the same, and that is why this assumption is unrealistic, because they are saying the risk faced by the company remains same, and hence shareholders continue to expect the same rate, whereas it may not be the fact, right? So realized yield, so we're talking about on the base of the return realized in past, realized yield. So let's take an example of this just to understand, realized yield. How do we take an example? How do we understand, okay, what is the realized yield from the past? Calculate the cost of equity from following data using realized yield approach. Mind you, when I will be talking about yield, I will be talking about not only the dividend, but also the price. Because mind you, the yield overall is not only return in the form of dividend, but also capital appreciation. So let's see, they are giving you dividend per share every year, 1, 1.2, and so on, and price per share at the beginning. At the beginning. Now, if I talk about year one, do you all agree that there are two returns which has happened? In year one is dividend, and one there is a movement in increase in price. So can I say there is a 1 rupee dividend and a capital appreciation of 0.75? Can we say that there are two returns over there? Do you all agree? So from 9, it has moved to 9.75. So dividend is also there, and then there is a increase in the share price. Now that means to calculate the yield, what we'll do is we'll add these benefits, that is 1 plus 9.75 divided by over investment of 9. So over a share price of 9, you are getting a return of 10.75. 1 as in dividend, and the value of 9 has moved to 9.75. So that means we are looking at 1.19 here. Similarly, in year 2, we are getting a dividend of 2, dividend of which has moved to 11 here. So that means there is a slightly decline here from 11.5. The value has gone down to 11. So in that case, you would see the growth in that particular year has gone down from 1.28 to 1.06. The value has gone down from 11.5 to 11 here. So 1.2 plus 11 on the investment of 11.5 here. So every year we are talking about a different yield, and at the end of the day, we are calculating the geometric mean of all the four yields here, and we are talking about a 15%. So let's take a quick example here. When we're talking about all the yields, so let's say we're talking about all the 4 years. So we're talking about 1.19, we're talking about 1.28, we are also talking about 1.06, and then we are talking about 1.07. So compounding would have taken this to a much more larger, but because we are talking about annualized yield, we are just taking a 1/4 power of the product of all these. So the product of all these would have been more than 70%, but since we are taking about a 1/4 geometric mean, we are getting that as a 15%. However, although you guys should know that, okay, how we are calculating the yield. Yield is capital appreciation plus dividend divided by the beginning value. But we are talking about that this is unrealistic, because we are just assuming somehow that whatever the risk shareholders had faced continues to be the same, guys. Everyone okay here? Everyone okay with this method? So just the computation, I think probably after the class, you guys can relook at the example, and for sure you guys can understand how we are calculating the yield in every year. Okay, Darshan, because we are talking about this is a product, right? So you're not just dividing just dividing by an addition here. It's a product. It's a compounding growth. That's why geometric mean. Okay. Now at the end we move to the last aspect. Okay, Shubham says earnings to remain stable is very impractical. That's why thankfully in Gordon's assumption is right. Yeah, so I think absolutely correct, Shubham. So that's why I use that word, that at least something was changing. Of course, we can't change everything unless a theory may not kind of be developed. So we move on to the last method, which becomes very, very important for you guys, is a capital asset pricing model. Now, before I even talk about that, guys, I would like to talk about two types of risk every investment, every share, every security is exposed. Very important for you guys to understand. One is unsystematic risk. Unsystematic risk, we can also say that a firm specific risk, company specific risk. If there is an unsystematic risk, you can easily diversify. You can reduce your risk by investing in some other companies. Diversifiable risk. But what if a particular risk is systematic? Something which impacts the entire system or entire market, all the firms, all the companies, think about government policies, think about political situation, think about pandemic, which affects every aspect. That is non-diversifiable. Whichever company you are investing, you are faced by the same risk. We need to know the two types of risk, and also the fact that CAPM will use the systematic risk factor. Okay, before I explain you this formula for capital asset pricing model, let me ask you a very interesting aspect. That case, let's say in India, let's say there is a scheme of government of India which gives you a return of 7%. And I say that don't invest there, invest in shares. And you know that if there is a more risk, you would expect more return, yes or no? If I want to invest, if I want to advise you to don't invest in that risk-free rate, because government of India would be in a risk-free return, a risk-free investment, and I am moving you from a risk-free to some kind of a risk, which means you would expect more than 7%. And that more is a kind of premium here. So it could be 9, it could be 11, it could be 12. I want more than 7%. Because if I am being advised that don't invest in government of India, don't invest in risk-free securities, go for shares. So I would definitely go for additional premium on that. But imagine I said that, okay, why don't you invest that in Uganda, in South Africa? South Africa, where some countries you have a ransom or a kidnapping as a part of the offer letter, or probably not so safe working locations, I mean to say. In that case, probably there is some systematic risk, risk also is attached. Guys, do you agree with me? If not only they're investing in shares, they're not only investing in a company which is not in India, but in a location which is not safe. There is a systematic risk attached to that. In that case, I will actually magnify. I will magnify the premium I want to expect. And that is why beta is attached, guys. That is why beta is attached. Now look at the formula here. Cost of equity is equal to risk-free rate. Just focus on RM minus RF right now. RM is market return, return on market portfolio. RF is a risk-free rate. So if I forget beta for now, and let's say in shares I wanted to expect a 12% return, how would my cost of equity would look like? 7 plus 12 minus 7. And you will laugh at me that what are you doing? A plus B minus A. It returns you B. A plus B minus A. What you are doing? Guys, why I am doing this? Because I want to keep a market risk premium separately. I want to keep a market risk premium separately because if this investment was in South Africa, I would probably use a beta of 2. I would magnify that difference of 5 to 10. So if a beta is 2, then the cost of equity will be 17% rather. Because I'm magnifying that extra risk, dangerous risk, working up in such kind of a country or such kind of a location. And hence you need to know the beta here. Risk-free rate plus beta into RM minus RF. I hope my friends, you guys are understanding the logic or rationale of the formula here. Quick confirmation from everyone would be really helpful. If you guys are doing good. Formula is clear to everyone? Great. Now, one thing you need to be really careful, examiner can be literally, playing some tricks here. Mind you, if they are telling you in exam that, okay, you're given RF and you're giving a risk premium, students have some tendency that they do RF. Let's say RF is 6%, risk premium is 8%. Some people do this 6 plus 8 minus 6. Mind you, this is absolutely incorrect because they have already given you risk premium. So in that case, you just need to do 6 plus 8 because that would probably 6 plus 14 minus 6. They're using the word risk premium. So please make sure that it is risk premium is RM minus RF. If they're giving you RM, if they're giving you risk premium, they're giving you RM minus RF. That's what I'm trying to say here. Make sure you understand that. Okay, let's take an example. Okay, there is a question coming in from Shubham. Had it been in USA? Okay, yes. Shubham, I would say less than 1 beta would be slightly impractical, as in you're saying that inverse risk, right? So probably you're saying that company to company. So I would say it could be 1, right? I would rather say 1. So if you're saying that, okay, in US there is a less risk, I would say that India would be 1.2 and US would be 1. I think look at that way. Yes, Darshan, systematic risk. Beta represents the systematic risk. Okay, let's take this look at this illustration, guys, at the bottom of the slide. Compute the cost of equity of IHG Limited, whose risk-free rate return equals to 8%. The firm's beta is 1.5 and the market portfolio return is 12%. So quick answer, guys, from everyone. Answer to the illustration at the bottom. Giving everyone 1 minute. And I'm already getting the answers. Amazing. Okay, I think this was a straightforward one, and I can see almost 7 to 8 answers. So Diksha, Himanshu, Sudhanshu, everyone is like giving me 14% flat. But now I get some different answer also. So what are we doing here? My risk-free rate is 8%. That means RF is 8 and RM is 12. Hence, K is equal to 8 plus 12 minus 8, and they've given us beta also 1.5. So it looks to be 14% to me as well, guys. It looks to be 14%, guys. So those of you who are giving me 14% is absolutely correct. Wonderful. Yes, Chinmoy. Okay, great, guys. So that was very good. Now, this is a very, very interesting slide. I think I want everyone to look at it. Cost of equity share capital. We look at a line called security market line. Now, what is this line, guys? Security market line is the line at which each point gives you the cost of equity equal to the risk-free rate plus risk premium into beta. So each point is kind of reflecting the capital asset pricing model here. This line I'm talking about, security market line, right? So each line is now depends on if I'm operating here, probably I'm taking less risk. But if I'm operating here, I'm taking a bigger risk. Depend on where I am, because now this bottom line represents, let's say we are talking about government securities. Government securities, government investment schemes that are risk free. As you can see here on the right hand side, some example that comes to a relationship of various securities here. So government bonds as pretty less. We move on to a slightly more risk, corporate debts, then preference shares, and then the most risky is equity shares. We say that more risk, more return you expect. That's my relationship here. Darshan, beta is of course composite, I would say product of composite factors, use of financial modeling and, how the industry behaves in various, scenarios. So don't worry, the calculation of beta will not be required for you guys. They will be providing you the same. Right. And I request everyone to please kindly read the note at the bottom of the slide, please. If the question already gives you risk premium, that means RA minus RF is already given. So make sure you do not do another subtraction over there. Larger risk premium indicates higher risk. Okay. So with that, we are done with the cost of equity, all the 5 methods. And I believe you guys should be agreeing with my statement when I started the cost of equity. I said that, okay, all the 5 methods you should know, but you know which are the most logical ones now. The dividend growth model and the capital asset pricing method. Right. So I hope everyone is clear in all the methods. We now move on to a very, very important aspect, cost of retained earnings. And I think all of you initially agreed with me that yes, cost of retained earnings is also important, because the reason is we are talking about the amount which is not yet distributed. It could have been invested somewhere else. Right. So it's important that we know this, right? So now generally cost of retained earnings, because it is part of the equity, it should be similar to cost of equity only. So cost of retained earnings, because it is part of equity, and equity maybe call it as that. Okay, it's a return expected by the shareholders, hurdle rate, opportunity cost. So ideally, the cost of retained earnings equal to cost of equity. However, let me say a very important point here. In case we are talking about a new equity being raised, in that case, cost of equity would be slightly higher than cost of retained earnings. Reason is because in case of new equity, there is a flotation cost that may be involved. So let us restart this point. We say cost of retained earnings is the opportunity cost of the dividends foregone by shareholders, because had that amount been not retained, would have been given you guys as a dividend. Similar to KE with respect to computational formula. Now, in case of a new equity, as I said, cost of equity would be slightly higher, because what will happen is the denominator will be the net proceeds, whereas for the cost of retained earnings, it will be the current market value. So that means, can we also say that KR is equal to KE? Basically, either we are looking for existing equity, and where we are talking about no flotation cost. Hence, we may say that in case of a new issue, cost of equity will be higher than cost of retained earnings. So then we are saying that, okay, they're not equal. That is only for the new issue, guys. I hope this makes sense to everyone. So you can see the formula here. When there are no taxes or flotation cost, KR is equal to KE. But of course, if there is a new equity mentioned or new equity is issued, then of course your cost of equity will be slightly higher. Now, mind you, look at another formula here. Where there are taxes and flotation costs, guys, what will happen is, if think from a perspective, if there are taxes and there are flotation costs, what is a cost of retained earnings? Amount that would be the expected by the investors, had that been distributed to them, would have been invested somewhere else, guys? Yes or no? But do you also agree, had this amount distributed, you would also pay taxes? Had this been distributed, investor would definitely go for a taxes, guys. You guys agree? And if you would have invested somewhere else, you would have also incurred some flotation cost. Investment would also lead to some kind of a flotation cost. Very logical. I would expect that you guys please confirm if you are with me on this. So we are looking at, had these been distributed, there might be have been a tax implementation, implications on the shareholders. And not only that, if they would have been investing it somewhere else, they might be incurring some flotation cost. And hence, the formula is slightly different than KR is equal to K into 1 minus T and 1 minus F. That means the rate of tax, because you would be paying tax, so net amount for investment will be less. And then whatever the flotation cost, 1 minus F. Right? So interesting here. Interesting thoughts going on. So then we look at illustration here. Face value of equity shares of a company is rupees 10, while current market price is 200. Company is going to start a new project and is planning to finance it partially by the new issue and partially by retained earnings. We are required to compute cost of equity shares as well as retained earnings if the issue price is 190 and flotation cost is 5, and dividend at the end of the first year is expected to be 10 and growth rate will be 5%. Interesting. So some food for thought towards end of the session today. We are looking at a very, very interesting, question here. So what do you think, guys? What will be the cost of equity in this case? Can anyone tell me what will be the cost of equity? Because there is a new issue is involved. So we are looking at D1. D1, mind you. So guys, mind you, D1 is probably given to you already. D1 is already given to you already because it's the end of the first year. Dividend expected 10. So we are absolutely not using a CAPM basically here. It's not a CAPM based question here. We are looking at D1 upon P0. So 10 is my D1. What would be P0, guys? What would be the P0? So you're talking about a new issue here, which is issue price is 190 and there is a flotation cost, so 185. So 10 upon 185. Am I correct, guys? That is one part. And then plus, of course, the G. Are we getting a 10.41% cost of equity? Everyone with me on this? Please check. Whereas, if we are talking about partially by new issue and partially by retained earnings, so what would be the existing equity also we need to calculate? That will be my KR. That will be 10 upon what would be the existing equity, guys? Again, the market price 200 plus 0.05. So we are looking at 10% here. So I can easily compute that, okay, for the new equity, it's 10.41. But for the existing equity, which happens to be cost of retained earnings, is 10% for us. So guys, we are looking at that cost of equity because we are looking at a new issue in this case. They've given it a question partially by new issue, partially by existing. So this is my retained earnings or existing equity. I hope everyone makes sense out of this. I'm giving everyone 1 minute to probably digest this, recapitulate this illustration, go through it once again. Let me know if there are any doubts. So all okay, 10.41%. Any doubts? I think Bhumika gave me an answer. A couple of more students gave me an answer. And for the retained earnings, guys, is it clear? It's existing equity. What about others? Shubham, Manisha. Great. So I think almost everyone is confirming that calculation part is clear. Okay. Now, last couple of tidbit questions for you for the day, and that we'll be wrapping up. We have cost of equity of a company is 20%. Flotation cost is given to us 5%. Rate of tax is also given. So you know what to do, right? If they're given you so much information, are they indicating something? That means there are flotation cost. That means they are flotation costs. So we are talking about, cost of retained earnings is cost of equity into 1 minus T into 1 minus F. So it's a simple mathematical formula. Cost of retained earnings is equal to KE, that is 20% into 1 minus tax. That is, so if that is distributed to you, that's a 70% you get. And there is a 5% flotation cost. So you're investing only 95%. So you're getting a cost of retained earnings is 13.3% here. 13.3%. Guys, I hope this is the formula which I was telling you, where there is a flotation cost, there is a taxation involved. So you need to remember this formula, please. Okay, so now, guys, couple of questions for you guys as a homework at the bottom of the screen. You need to calculate the cost of retained earnings in the following scenarios. They're giving you two situations. One is a D0, P0 and growth rate, and other one is RF and RM. That means the homework kind of requires you to recapitulate whatever we have discussed in terms of the capital asset pricing model and also the dividend growth model. So you guys will have answers with you, but I want you guys to calculate this on your own first, and hence you can match that later on. And my humble request as we kind of wrap down today, guys, that whatever we have done till now, please kind of recapitulate everything, read everything, do some practice individual components. What lies ahead on the other side of the session is definitely a lot of practice, and we move on to the actual cost of capital, that is a weighted average cost of capital. So with that thought, let's kind of attack on just a couple of MCQs, guys, for everyone before we end. First, I want your answers to be given to me 1 and 2. Give me answers with your question number, like 1B or 2D, something like that. And don't worry, we will start Friday's session also with a couple of MCQs. This is the last set of MCQ which I want. So what do you think the first one should be? 6% is risk-free rate. market rate is 12, cost of equity is 18. What would be the value of beta, guys? Already getting some answers here. So they're giving you cost of equity is 18. So risk-free rate is 0.06. They're asking you beta is 0.12 minus 0.06. So we are looking at 0.12 is equal to beta into 0.06. Hence, probably everyone looks good here, right? I think most of you have given me answer as option number D. Amazing, guys. I think one or two students gave me answer C, but just check if some problem in the calculation. I think almost more than 10 students gave me answer D here. D for Delhi. Great, guys. Very good. What about question number 2? Which of the following source of fund relates to reinvestment or implicit capital? Well, I think that remains to be the easier one, right? Remains to be a very, very easier one. Chitra Devi, I saw your query. I request you to kindly email the same to fm-inter@ici.org, please, for the scheme for revalidation thing, right? Just please email the query. Okay, so I think so. The which of the following source represents the implicit? I think the implicit is the keyword here. Implicit capital is the keyword here, and that is to be a retained earnings. So debentures, preference, equity, they have a clear-cut cost, but implicit means is a kind of implied cost. So you may not have to pay anything on retained earnings, but there is an expectation, right? The shareholders did not get the dividend. They expect the investments. They expect that to grow, and that's why the retained earnings is the correct answer, guys. Amazing. So only I think one or two students selected C or D, guys. Please understand the word implicit and also the word reinvestment. It's the retained earnings, which is profit not given as dividend, profit not distributed, that is actually reinvested in the business. That's reinvested in the business. That's the retained earnings, guys. That is why it's an implicit capital. Then you don't have to pay anything on that, but the expectation of the shareholders that, oh, we did not get dividends, that's reinvested. We want this money to grow. Okay, folks, so I think that brings us to the end of the session, please. Thanks a lot. I think it was wonderful with all of you, and I'm pretty much looking forward, right, with a lot of more sessions coming up on our way. So the next one falls on Friday to join us on the second half of the cost of capital. There we will learn how to calculate weighted average cost of capital. Now today we learned on the individual components, and we also do a lot of practice on Friday. Then 10 days later, we meet for investment decisions, as I said, and then towards the end of the month of May, we'll talk about working capital management as well. So amazing, guys. So I think it was wonderful. Huge round of applause for everyone for making it so participative. Make sure that you kind of continue to do your hard work, and let me remind you, just ensure that you maintain that discipline, dedication, and do some planning, kind of timetabling how you follow your practice and your studies, guys. Happy learning. I request everyone to be safe, continue to do the hard work with the same dedication, and be safe, guys. Have a good evening, good night, all of you. Take care. Cheers. Bye bye.